Hi everyone, this is Ivan Illan, the founder and chief investment officer at Aligne Wealth Advisors Investment Management, also known as AWAIM. Thanks very much for joining me on this May 2025 update. Of course, as usual, it's important to remind you this is unscripted. This is highlighting some research that we do here with our investment committee. And this month I'm going to throw our attention to a couple of interesting charts. Certainly we always think it's interesting and we want to share this with our clients and prospective clients, how we see certain metrics in the marketplace. And the first chart is, and so we're just going to dive right in. The first chart is showing the spectrum of yields that are available from investment grade, very high-end investment grade corporate bonds here in the United States, and scaling all the way to B, which is really the second rung in high yield U.S. corporate debt, or also known as junk bonds. And some people don't like the term junk bonds because it thinks it literally trashes that particular tier of debt, but you know, it's a colloquial phrase, so we use it, and you can see by this chart that in that neon green that junk bonds, or B rated debt, which again is that second rung below double B, is yielding right now about 7.71%. So for all intents and purposes, this would be a very attractive yield. And you compare that to a AAA effective yield of 4.79%, just under 4.8%. This is about, call it roughly 300 basis points of more compensation, more reward, more return from a B-rated debt relative to a U.S. corporate that is rated at AAA, which is the highest grade, investment grade debt that you can get in the marketplace, followed by triple B, which is right now at around 5.56. Triple B is one rung is above high yield or junk bond status. It's the lowest rung on the investment grade spectrum. So right before you fall off into high yield status or junk bond status, you'll be at triple B, and most downgrades that occur from triple B down into double B status. So it is, and it happens to be the largest area of or largest concentration of U.S. corporate debt is actually in triple B debt. So this is a very important part of the tranches of ratings because it's so populous. So triple B being the most populous, about 60% of all U.S. corporate debt in the U.S. is in this triple B area. So certainly that in and of itself is a little concerning. When you have such a large concentration in anything, it becomes concerning. So that's something to keep in mind and note. So this is the yield spectrum. This is the range of yields that are available through, this is updated just through the 2nd of May. And this is looking back at the history, going all the way back to the beginning of 2022, just before the Federal Reserve began their interest rate hike cycle. And so this is interesting. This is the place I wanted to start with, just to show you the gross yield, these nominal yields that are available in the marketplace from these different tiers. Now, this next chart that you'll see is, I think this is where things get very interesting. It's also the subject of the most recent research highlight on our website, which there's a link in this video to that page where you can read more extensively the narrative around this rationale. But this is what we think is very interesting, which is when you look at the yield change, the percentage change of the yield in AAA, U.S. corporate AAA, versus single B, high yield or junk bond debt, it is kind of striking because you have more than doubled the yield on your AAA debt. It's up about 133% since the beginning of 2022. That is a significant increase, more than doubling the yield for U.S. corporates, these highest grade debt holders, debt issuers. Meanwhile, the B, which is the lowest grade shown here, is up only about 64%. And the double B, which is also high yield status or junk bond status, is up only 84%. And triple B is up about 111%. So this is the point that we're making in the research highlight, and certainly in this video, which is, if things are really quite dire in the economy, if things really truly are awful, and we're headed into some nasty, prolonged recession, or even worse, a depression because of tariffs or whatever, certainly the junk bond market is not saying this. The junk bond market is not saying that we're headed into some awful, terrible place, because the yields have not increased so substantially as to compensate an investor for that risk. So that's very interesting. That is a big headline, which is junk bond markets are saying there isn't a big, bad, horrible recession headed our way. And at the same time, you're seeing the highest grade U.S. corporates with a significant increase in their effective yields, more than double, like I said, with AAA, or a little more than double for triple B, which is the lowest rung on the investment grade spectrum. And so, as per the research highlight, what I was specifically looking to communicate is, these very healthy companies, these highly rated companies, financially quite strong and quite stable, the market is really saying something. It's saying a couple of things. Number one, perhaps we spent way too long at very, very low interest rates, and now we're correcting for that. Now we're back at more normal, historically normal interest rates for investment grade debt. And so that adjustment means that there will be this significant increase on a percentage basis relative to high yield. But high yield was also relatively lower as well. Everything was lower when interest rates were near zero. So this correction that's taken place has overcorrected within the highly rated, financially highly rated companies, and or very strong and financially solid companies. And so this is perhaps a little concerning, because maybe the question is, can these financially sound businesses maintain their debt servicing now that it is more than doubled? Can they maintain those debt service payments without having to cancel capital expenditure line items, without having to reduce their payroll line items, without having to cut marketing or other growth initiatives that the business may have? Because making debt service payments is by far, next to payroll, one of the most absolutely important things that a company has to be doing. And it has to be doing that because if it misses a single interest payment, or certainly a principal payment, it's a technical default, which will now mean that company is going to have a lower credit quality, and that will make all of their debt much more expensive into the future. So certainly CFOs at multinational corporations, any corporation, small or mid-cap companies, they're all very obsessed with this, which is maintaining credit quality and credit ratings so that future debt is not as expensive. So there's a lot of other expenses that would be cut in favor of being able to meet the increased debt service payments. So maybe that's what this is saying to us. Maybe that's what the message is. The market, the fixed income market, which, as some of you who have watched this, and certainly clients that know me, I started my career at Nuveen Investments in Chicago at the headquarters, involved with municipal bonds in the underwriting and product distribution for closed-end funds of municipal bonds. And so I've always referenced the fixed income market as a very helpful guide to risk assessment in the broader economy. And so this is quite interesting. It's interesting enough that our clients do know this. We actually took a little bit more of an allocation within U.S. high yield because the prices there have provided some opportunity during this recent decline and, of course, rebound. We were able to get in some very nice yields, about 7.8% yields in the U.S. high yield market. And that may be as good as it gets for a little while. We'd like to see a little bit more. However, in order to see more yield, you have to see more risk come through in the market, and the fixed income market needs to be really, really concerned about the ability for these lower financial companies to provide higher yields and pay their debt and not go into default. Right now, maybe there's a mild to very little chance of a recession based on what the high yield market is broadcasting. If yields were supposed to be on par with where we would see them relative to these AAA or BBB debt, we'd be looking at something closer to maybe 9 or 9.5% effective yield for junk bonds. And we're not really seeing that. We're seeing, like I showed you, and for single Bs in that 7.8% range. So there's quite a bit of room here for more risk perception within high yield. But are we going to get it? Is there really a big concern? Certainly, the fixed income market is not saying that it's too worried about certainly our lowest quality companies in the United States. The fixed income market isn't that concerned about their ability to pay back that debt as promised, whether it's interest payments or principal payments. I think that's a very good message and a very positive message for the overall U.S. economy. And with that, please, if you have any questions at all, don't hesitate to reach out to us in the link provided in the video, or you can email us at info@alignwealthllc.com. That's info@alignwealthllc.com, and someone on the team here, maybe even myself, will be excited to respond with any questions you might have. Thank you so much for joining me this month, and hopefully you gained an insight or two specifically this month around the fixed income markets here in the U.S. Take care.